because of the psychology part of it, there is a difference between you trading on a demo account with no pressure and then you trading on a demo account being evaluated, because people are monitoring that. Traders, risk managers are monitoring your performance, and then they'll decide if they're going to fund you if you pass. So it's like, okay, you can lose a maximum of 10% and then 5% per day. Now, in my experience, a lot of people kind of fail on the 5% per day. They open too many positions. They don't know how to control risk. So the risk management side is the biggest factor. They go over the 5% and they fail. So that's been my experience of a lot of people, how they fail. And then by the end of the evaluation, the account has made money, but they failed because they broke the 5% rule. And some people don't understand it. And they're like, well, but I've made money, so what's the problem? Well, there is a problem, because the whole point is those parameters are set there, one, to see how disciplined you are, and two, because nobody wants to invest in high risk traders. We want to invest in traders that are basically really respecting risk. And actually, you know, if you think of myself like two profiles, one profile is who I am today as a trader, super disciplined, risk management, a real fundamental part of my trading, versus a young, hungry to make money Andy Demi, who had a lot of skills, but didn't have control of that part. You know, that guy lost money. This guy is consistent. And that's what you've got to think about. Like, risk management sounds so boring. You know, why do we want to risk manage? And in some respects, I understand it, but I've learned the painful way that actually, if you don't control risk, it's just a matter of time. I don't know when, but you will blow up your account. You will lose money. And so it's up to you whether you go through that process and go through that painful experience, or whether you just kind of take my advice and just say, look, you have to risk manage. And it doesn't matter, you know, a lot of the time, why do people break their rules? Simply because they're trading a tiny account and it's just not interesting enough for them. If they're doing 1% or £500, it's just not interesting enough for them. So they don't, like, you know, they don't want to make £10 on a trade if they've spent 3 hours finding that trade. That's what it comes down to. So then they end up saying, well, let me just risk a bit more, or they don't think about risk, and that's how you end up blowing up your account. And you don't even kind of, I don't want to go down this area because I know you've got a lot of things that you want to ask me, but
it's okay if it's valid, because if this is one of the key areas that people fall down on, then we should kind of expand on it. So any little Demi nugget bombs, feel free to pull the grenades tonight, mate.
Okay. Well, what I was going to say is then in that case is that most of the time we might tell ourselves that, okay, but it's only £500. Like, who cares? Like, I can just refund my account. So they take a punt. It didn't work out. They lost a few £100s, and if you're earning good money, you might not even care about that. But it's the cycle. It's the damage that you're doing to your subconscious, which you don't take into account, which is so important. What we do every day is a program. We are programmed. Everything we do is a program that has been learned. Okay, so over time we learn, and that's what we do. And we have beliefs that we have about certain things. So if your experience has been blowing up account and that's your only experience, then that's what you believe as a trader. Whether you tell yourself consciously, actually, I'm a good trader, I'm a good trader, I'm a good trader, your internal beliefs are basically ones that, what's your experience? What's your experience been? I've basically funded an account and I've lost it all. And so you have that fear inside you when you're trading and you don't realize it. And you have that internal thing that actually, I'm a losing trader. And that will impact you when you say, when I get serious or whatever. So yeah, when I've got a bigger account, I'm going to be more serious. But the problem is now you've kind of built all these bad habits, and your belief system is that I'm a losing trader and I blow up my accounts and I don't control risk. So that's going to impact your results 100%. There's no way it won't impact your results. So don't think it's a free lunch, just like you could just punt a few £100 and if you get lucky, you get lucky. It will have an impact on the rest. So you have to approach it professionally from day one. If you recall, for those that know how I started with a £2,000 account, and at that point I was extremely disciplined, in the sense that I understood that I wasn't going to make a lot of money being risk managed with £2,000, but I knew that I would make a lot of money if I could take that formula, get more money, and then apply it with much bigger amounts of money. So I was extremely disciplined. I stuck to my rules. I averaged roughly £200 a month, right, of income. But that gave me the confidence and the boost that I needed to believe that actually I can do this. And that was a big stepping stone for me. So that's what I kind of encourage people to do, at least for a short while. And then the great thing is that there is funding now, as we've been saying, where you can take that great inside knowledge, that know-how that you've built, and then say, right, now I can do this on 100 grand. And like, instead of doing £200 a month, I'm making 10 and maybe keeping 7 of it. And suddenly your life has changed. Like that becomes a serious income which will allow you to leave your job. So that's the price.
Very good. Very good knowledge being shared there. And I guess, like you're saying, you know, the analogy is, we don't learn how to drive in a Ferrari, do we? And it's like people saying, well, I'm going to learn to risk manage when I've got more money. You know, if you learn to drive in your Nissan Micra or your Volkswagen Golf, as was my case, you know, you learn the fundamentals there, don't you? Because you don't pass your test, and then you get into a faster car, and even then you're going to kind of skid off the road a couple of times, or, you know, kind of do a few, whatever it is, off the road and stuff like that if you're not careful. And if you start driving a too fast a car too soon, you can kind of skid out of control. So it makes total sense. We've got loads more to cover, guys, but we're just checking in on some of the live comments. Nicholas on YouTube, great to have you with us. Thomas in the Philippines, can you pop over to Manila for a crop, Gavin? I'm not sure if you're a professional hairdresser, otherwise you will not be touching my hair. And Lucy says, that's Gav's boy band look. Thank you very much. I'm not sure if that's a compliment or not, but Brucey is forever cracking the jokes, so we'll take it as a laugh, that's for sure. So thanks a lot for your comment, mate. Now, going back to this whole funding and evaluation process. So we've spoke about drawdown. We've spoken about the daily limit. Now let's talk about another component of the evaluation process, which is a lot of people get confused about the days. So generally, the first phase, you have 10 trading days that you have to place a trade. Do you want to just break that down a little bit more of the requirements, and maybe there's a way to hack around that? I guess maybe in your experience, you could share one of the biggest mistakes that people make, and then a way in which they can look to turn that part of the evaluation process around.
Yeah, so the minimum 10 days is simply so that we've got enough data. So generally, I mean, well, I talk for ourselves, but also for like other prop firms, I assume. So you can't get one lucky trade that basically allows you to pass the evaluation. So you have to take 10 trades minimum, 10 days of trading minimum in the calendar month. So I think that's more than fair. And then on the second phase, you also have to take another further 10 days, I believe, from memory. Now, you know, the reason for that, as I said, is simply so that we can see enough data that you're being consistent and not just kind of taking one trade. You know, from a personal point of view, I mean, I know different firms offer different things. You know, when I invest in someone personally, I want to see consistency. I want to see, like I said before, I don't want to have somebody take one trade, make 10%, and then literally take little micro lots to just pass and game the system. I know that there might be companies that will fund you even doing that. The reality is, guys, though, if you're doing that, you might game the system, you might pass, and you might get a funded account. But as I said at the start of this show, the reality is that if that's what you're doing, you're not going to achieve the goal that you want anyway, and you're just kind of wasting your time. You know, you're not going to be able to make a consistent living from trading by doing that, because the next time you take a big punt, there's going to be a point where it doesn't work, and instead of making 10%, you lose 10%, and then you're out of the game and you're going back to square one. And so you may as well actually trade, you know, correctly from the beginning, and you'll have a much better chance of succeeding and actually, you know, achieving the goal that you're aiming for. So focus on the goal, focus on the prize, which is ultimately, what are you doing it for? What do you need to be making? How consistent are you in your trading? And if that becomes your focus, then you won't try and game the system and just, you know, maybe take one lucky trade and then take little mini lot trades until you get to the 10 days and then pass the evaluation, because it's not going to really help you in the long run anyway.
So how should you, we're starting to get some data now, right? So you're not allowed to go over 10% drawdown. You're not allowed to go over 5% in a day. So now this is starting to give us some clues as to what strategies, or not even strategies, but just the risk management. This is still all really to do with risk management, right? So if you have to make 10 trades, or one trade a day for 10 days over a calendar month of 20, then what are some ways that people can look to do that? Because obviously there's going to be people that are like, well, I just want to go for it. So yeah, what would be some advice really for that? Because obviously that means that you if you break that down, you've only got a certain amount that you can risk per trade, and you should only really be doing a certain number of trades over those times, right? There must be some ways that you can break this down to make it a bit more approachable and achievable.
Yeah, it's simple. Like you need to have an idea of how many setups, according to your plan, according to your personality profile, how many trades you will typically take per month. So that's important to know that. So that's why if you have done what I said at the beginning, which is like, you know, taken the time to build a plan that fits your personality profile, you've practiced with it, you've you know, you've gone on a demo account, you know, and you've kept a track record of all the trades that you've been taking, you'll then be able to look back at 2-3 months of data, or at least a couple of months of data, you know, where you can say, okay, well, look, on average, I take maybe 10 trades a month, or on average, I take 50 trades a month. So why is this relevant to your question? Well, simply put, if you're somebody who only takes 10 trades a month, then you will probably want to be risking more than, say, 0.5% per trade, right? Because you know, if you only take 10 trades per month, then the minimum you should be risking is 1% per trade, minimum. Because I know we say, look, risk between 0.5 and 1%, but actually the most important thing is to understand is that you have your portfolio risk. So how much risk are you actually taking on per month? So if you have a win ratio of 50%, for example, then, and you know, this is probably the easiest formula. Like, so if you know your win ratio, and you know basically how many trades you take on average per month, you can kind of calculate what you should be risking. So if you have a win ratio of 50%, then, and you normally take 10 trades per month on average, you could risk 2% per trade. So 2% per trade, that's probably about the right level. But if you want to kind of be a little bit conservative, then you can go to something like 1.5%. Whereas somebody else is maybe doing, say, 50 trades a month on average, so they're taking lots and lots of trades, then they're going to want to do a lot less than 1.5. So they'll be more like 0.5% per trade. So, you know, you have to, and the only way you're going to know that is by knowing on average roughly how many trades you take, with not ideally, but actually really how many do you take? So given your work, given everything else going on in your life, and how many setups are available according to your rules, how many trades do you take? And then obviously the more data you have, the more accurate that's going to be.
Mm. And is there an optimum time to start the process? So ideally, I guess in your mind, and no one knows, right? It's all probability game, and you say this more than anyone, but I guess if you have one that you think is a particularly higher number of confluence points, for example, and maybe is there a time to wait for a setup like that before you start the evaluation, or do you just pick a date and then you're like, right, that's it, that's the date that I'm picking, that's what I'm going with?
I mean, both are okay. I guess, as we know, like that, you could do it that way. You could wait for, let's say, a better setup than others, but yeah, I mean, you could do that. There's definitely an argument to do that. But yeah, I don't really have a strong opinion on that, to be honest. I think realistically, yes, there will be some trades that have higher probability, but as we know, anything can happen with any trade, so it doesn't guarantee anything. But yeah, if you want to be strategic about it, I guess you can wait for a good setup. Personally, I don't think it's going to make such a big difference. I think if you're good enough, there's plenty of time. So I prefer just to say, right, I'm starting on Monday and that's it. I start on Monday and I just start looking for trades rather than sort of waiting for that perfect trade personally. But yeah, I can see why you would consider doing that.
And I guess it depends again. Now we're starting to get these layers. So there's all these different parts of the recipe, like knowing how many trades you take, what is your percentage win ratio, and then you can kind of have KPIs, right? You can start to have the data. You can start to have the latitude and longitude towards your destination, if you will. I guess that would work depending upon someone's personality type and if they were a less frequent trader to maybe wait, because if you only take 10 to 15 trades a month, how do you know you're going to get, I guess you're going to have to be pushing the boat out to hit that 10-day minimum benchmark if you're only taking 10 to 15 trades a month, because that's based on, you might have certain criteria. So again, it's worth giving all of these sorts of things some thought. So another area that, were you going to say something then, mate?
No, that's all.
Okay, cool. So that's another component that we've checked off the valuation process. Hopefully, guys, this is making sense to you and it's giving you some value in preparing you for if and when you get down that process. And maybe we've got people who are watching who have gone through the funding process and are funded traders. If you are, let us know. That would be great to hear from you. Also, if you're brand new to this, hopefully it's not too overwhelming. So again, if it's making sense to you and it's giving you some inspiration, then let us know in the comments section as well. So another area that a lot of these options of prop trading firms offer is that you can trade and you have to follow this. So you've got a certain drawdown max, you've got a certain daily drawdown. You have to trade a minimum of 10 trading days, but you're not allowed to hold positions. You're not allowed to stack. You're not allowed to hold positions over the weekend, should I say, and you're not allowed to hold positions overnight. How much does that impact a trader, and why would a company set that parameter and kind of clip the wings of a trader? Like, why would they do that? Why would they not let people to do that?
Well, I can't speak for other firms, but I know that's something that we won't put on the trader because I wouldn't want that put on me. So, we will allow people to stack trades. We will allow people to hold overnight and over weekends. Simply put, because I do. And I think it makes it challenging when you are being restricted as to how you normally would make money. So if you have to adjust your plan, and sometimes it can happen with investors. Now, if you're starting out, I guess you just kind of say, yeah, whatever your rules are, I'll change for you, right? Whereas when you kind of know your worth and you've done it for quite a long time, you're like, well, no, you change your rules for me. So because I'm a professional and this is how I make money, so I'm not gonna, if I change what to what you're asking me to do, essentially I can't deliver the same results that I've been delivering. So it's really, really important within reason that you work under the same conditions that you've used to basically prove that you are ready for the evaluation and ready to be funded. Now, if you are able to do it within that rule structure and you've done that on your demo account and you've built your track record, then that's absolutely fine. But I just generally don't believe that restricting traders that way is going to help anybody. I understand why they do it, because it means that there's less risk. So overnight positions can have some risk, but you know, I know for speaking for us, we have risk managers that take care of that, so that's not really an issue. The only real big risk is the weekend. I've got to admit, there is some risk there. So, you know, over the weekend, something could happen. You know, the FX markets are not open Saturday, Sunday officially, but they are still working in the background, so you can have a gap. But it's very, very, I mean, if there is some gap that's that costs us a bit of money, it's a risk that I'm willing to take on my own account, because the FX markets are stable. You're not going to have like a huge gap. It's not like stocks where something could be said about a particular stock and suddenly it's like, you know, massively gapped down from the closing price. You know, we're talking about huge, massive economies. You know, we're talking about trading the major currencies, right? Sterling, euro, dollar, Canadian dollar, you know, the Kiwi, Australian dollar, Swiss franc. Of course, the peg was the exception, but like with the dollar, with the Swiss peg, that was like that was an extreme black swan event. But in general, 99.9% of the time, it's not an issue, and that's why I don't believe it's something we should you know, we should basically restrict traders with.
Awesome. So just checking in with the comments. This is the best FX. This is, if you're not a trader, then you are destined to become a trader. Amos Umlambo.
Ah, I like that.
That you are destined to become an FX trader. A 7-figure FX trader with that name. Thanks for having me with us. Huh?
Amos, more Lambos.
More Lambos. Exactly, mate. Exactly that. And Michael Bruce. So best for traders not to hold positions anyway, especially on the weekends, or isn't that viable?